Green Street Trust International, owned and operated by Rennell Jump and UConn legendary men's basketball player Jake Voskuhl. They specialize in tax plans for businesses large or small. They will save you money or get you a big fat return on your taxes. To schedule your free strategic tax planning session today, go to www.greenstreettrust.com. Pete Finch and the Finch Law Firm is located in Bridgeport, Connecticut. If you've suffered any type of personal injury, slip and fall, car accident, your mother-in-law ran you over with her car, your wife got angry one night and decided to stab you, the Finch firm is for you. Pete has won legal battles all across the state of Connecticut. He will go to war to get every dollar you deserve in compensation. You just have to remember, in a pinch, call Finch or go to his website, thefinchfirm.com. Dynamic Human Performance is owned and operated by UConn legendary running back Andre Dixon. He trains boys and girls of all ages, all sports. He has a boot camp program 7 days a week, 6 a.m. You want to get in shape, you go to Andre. He has an athletic development program where he trains boys and girls in the sport of their choice from the ground up, helps them reach their full potential, be the best they can possibly be. Andre has sent boys and girls to college on scholarship for all different types of sports. To work with the best, he has a 5,000 square foot state-of-the-art facility in Hartford, Connecticut. Go to www.dynamichumanperformance.com. All right, and here we are, finally back with a new episode of In Focus with the man himself, Robb Hill of R. Hill Enterprises, Inc. Robb is a minister. He is a life insurance mastermind. He is an accomplished author, public speaker, and he is a professional at pulling people's heads out of the sand and opening their eyes to see reality one at a time. Robb, so great to see you.
It's so great to see you too, brother. Yes,
yes. And we had a great audience in our last episode, which we appreciate greatly. Thank you. I wanted to ask you just a few questions that we had before we get started.
Okay.
So we have, I believe this is Robert. He is from I believe he's from Chicago, from your area. Mm-hmm. He was trying to do, I'm sorry, I've never heard of this, a needs analysis. And he was asking, how should someone decide between term and permanent coverage for life insurance at different life stages?
Well, see, at that particular juncture, what he's doing is he's got this thing confused. It's not whether or not you use term or whole life. It's not an either or situation. What you got to look at is what the needs are. This is why a needs analysis is performed. Okay?
Oh, so there is the needs analysis is actually something.
I do those too with my clients.
I didn't know what it was. Okay.
Right. Our needs analysis is simply this right here. You're the breadwinner. Okay. Your spouse, your significant other also brings in income, but you're the main one. Okay. So if in the event that something happens to you, not only are they going to miss you, but they're also going to miss your income.
Correct.
Okay? And this is why different types of life insurances have been created. Term life insurance is just for income replacement. Okay.
Really?
Really. That's what it was designed for. A lot of people sit up and they get to this point where, well, should I get whole life or term, when the real actual answer should be a combination of both.
Oh, okay.
Okay.
Because a friend of mine got term life insurance, and
Right.
he's my age, around 40, 42. And
Mhm.
I was like, that. Why would you get term? Because I think he got 20 years. Because I know that from what I understand, at the end of those 20 years, you have to be reassessed again,
No,
and whatever you. No.
actually,
Okay.
actually, what happens is you're right. At the end of those 20 years, you got to be reassessed. Okay. But the way that a term life insurance policy is structured, okay, and people usually get are 10-year terms. Okay.
Oh, okay.
Okay.
Then I
And
don't know
so
why
you
you get.
get this term, and then at the end of every term, your
You're right.
premium increases.
Correct. Right.
Okay. And
Because
you
you're
have
older.
right, and you have to requalify too
Correct.
every time.
That's I
So
said that for him.
right. So see, it's not the term life insurance, and I'm gonna let you in on the unknown secret. Term life insurance gives you a lot of bang for the buck. However, it is the life insurance industry's cash cow
Oh, of
because
course.
only 1% of all term policies ever pays out.
1%.
1%. That's why they have them in term. A 10-year term. You hear the people on TV talking about, well, I
Yeah.
got $500,000 worth of
I
coverage,
hate
and it only cost me $39 a month.
when
Well,
I hear those commercials, Rob. I go ballistic now because of you. I do.
well,
I hear them on the radio. I go nuts.
yes, well, see, the reason
They're
why they're that
lying.
way is you got to look at the fine print. That person is 25 years old.
Correct.
Okay, they're not 55 or 65 or 75. All right, because term life insurance gets extremely prohibitive as far as cost goes as you get older, and then
Correct.
they also have a lot of restrictions as far as medical issues go and all this.
Yes. Yes. Huge medical
Yeah.
restriction.
Oh yes. So it's not a matter of whole life or term. The best answer is a combination of both, depending on each person's situation. This is not a cookie cutter situation. Okay. What we got to do is we got to analyze each and everybody's own needs, what they want to leave for their family in the event something happens, what happens if they live. Okay.
Yeah.
You can get
Yeah.
you a term. You can get you a term policy and in 20 years, 30 years, but what if you live?
That was exactly my thing.
Yeah,
Is
this
you don't.
this
It doesn't carry over, right?
no, it does not, and it does not build any cash value or anything like that. But what it does do is it gives peace of mind in the event that something does happen, it will pay. Okay, but now as far as whole life or term, see, whole life does two things for you. It locks in your age and it locks in
Correct.
your health.
That's what it is for the rest of your life.
That's what it is. That's what it
Yeah.
is. That's why you get a combination of both.
Okay, I apologize. Can you explain like what a combination of both would look like? Like, I mean, because you obviously want to get whole when you're younger, and then is term something you get when you're older?
No, you got it
Oh,
twisted. You got it backwards.
oh, I do.
Right. But
Okay,
see, these are not something that you put on the back burner. In a solid financial plan, you will have a combination of both.
okay,
Okay. See, term life insurance gives you bang for the buck. Whole life insurance does two things for you. It locks in your age and it locks in your health.
correct.
Right.
Right,
And so
right.
you have that whole life policy. Just in the event that you outlive the term, you still have the whole life.
Exactly.
And it has been building equity and this kind of thing like that. But see, there are a lot of reasons why to do it while you're young. Okay.
Exactly. Yes.
Because your outlay is going to be a lot cheaper. A lot of people they like to use the terms, well, how much does it cost? How much am I paying? And all this kind of stuff. If this is not your cable bill, my friend, you pay a cable bill. This
No,
life insurance thing is a repositioning of funds. It's
that's all it
repositioning.
is.
It's treating your dollars as soldiers. Okay,
Exactly.
that's what it is. In the event something happens to you, the soldiers come to the rescue for your family.
Exactly.
Right?
So, just so I'm clear, when is the best time to get term when you're younger, and then or do you get term and hold together? You were saying a combination of both.
With my clients, we do both at the same
Okay.
time,
Okay.
regardless to whatever the age may be. Because as you get older, term life gets really restrictive
Yes.
as
Yes.
far as the premium outlay goes. But we look at all the
Oh, I
avenues.
see.
We look at all the avenues to make sure that in the event something happens, that the family will not only lose the person, but they won't be in a devastating financial situation.
Position
Okay, see,
because of
this
it.
is what happens. A lot of people they look at the homegoing of a friend or a loved one and all that, and they just look at, oh, he's gone, he's gone, he's gone. But you know what else is gone? So is his money.
Yeah,
That income,
yeah.
that check stops too.
Yeah.
Okay, all that. So what we got to do is we got to get people to preparing. And I use a lot of how would you say, monikers. All right, look, dig the well before you get thirsty. All right.
Yeah. 100%.
Yep. This is what life insurance is all about. It's all about preserving your family, your legacy in the event something happens to you. We don't know when we're gonna go. We have no idea.
No, you're right.
So it's better to be prepared. You heard me say many times. It's better to have it and not need it than to need it and not have it.
This was another question asked from Cindy. She wanted to know, what life insurance strategies do you recommend small business owners should use for succession plans? And is key person protection really worth it, or are there better ways?
No, actually, the key man insurance is worth it.
Oh, key
However,
man.
it's not something that you would just speak about. See, what needs to happen is there needs to be a needs analysis done.
So there actually is a needs analysis.
There is a needs analysis because what life insurance is life insurance is a solution. Okay.
Correct.
However, we got to realize that there is a potential problem.
Yeah.
Okay? And that's what we address with financial products. Okay.
Right.
Because you're not going to be able to get a life insurance policy after you're dead.
No.
This is before that occurs. Okay.
Absolutely.
So we have to do all these things prior to that happening. And as far as business is concerned, this is where we take a deep dive into what's actually needed, because not only does the business need to be sustained, we also got to make sure that the families attached to that business or attached to the owners of that business are not put in peril financially either.
Absolutely.
So it's not rocket science.
No,
but I mean, it does take some
it takes planning. You got to know what the hell you're doing.
Oh yes, yes.
Rachel had asked basically about the insurance industry and AI, because AI is becoming prominent in everywhere, from the medical industry to attorneys to whatever. Is AI a tool that insurance agents use at all? I mean, can it be used for underwriting?
Well, yeah. I mean, it can do anything that a human can do, pretty much. But I mean, let me submit to you this: AI did not just start happening. This is not something new. This has been in development for many decades. Okay.
You're kidding me.
No, I'm not kidding you at all. No, now it's being rolled out to the public. Now AI has already been there.
You're saying that the last 20 years or so, they have been working to develop AI products?
Just go ahead and double that to 40 years.
So 40 years ago, they had the idea in their head that we could create software or a program like AI to do many of the menial things and even more important jobs and do it better than people. Like that was their plan.
What do you think has been running these robots? I mean, remember when the robotics industry got widely recognized? What do you think was running that? It's artificial intelligence, brother.
I saw in Philadelphia, I don't know if you read this story, Uber Eats cut a lot of their drivers. They now use these robots. The robots go, they're like, this size right here. They pick up your food and they drive along the sidewalk and they go to your house. And people have been furious about this and have been kicking the robot, throwing stuff at them. But when I saw that, I legitimately was shocked. Like, they are, I mean, are they going to be replacing Uber drivers next with robots for AI and just drive the car? Like, they got a robot to do this.
Anything that a robot can be performed to do is going to be done by a robot.
Jesus.
The artificial intelligence, they answer phones 24/7. They text and all this stuff. Right. Well, see, they are the artificial intelligence is only as good as the rational intelligence makes it.
Correct. Yes. Okay. I mean, you have to make it how you want it, and you have to teach it. But it learns based off of you.
Let me drop this on you right here. Okay. Change in my grandparents' generation took 100 years. Okay.
I agree.
And my parents' lifetime, it still took 100 years. In my lifetime, I'm talking, it's like it's been cut in half, 50
years. It seems like it's all at once, Rob.
Now it's down to 6 weeks. Change happens fast. Okay.
Yeah, that's what scares me.
No, it should not scare you. It's like people think that man is getting smarter. That's not the case.
No, they're getting dumber.
What's happening is what used to be taboo is not taboo anymore.
Wow.
Okay. Those things that we used to not do, now we do it.
Well, because the word you said, tolerance.
Oh, that's a big part. Why don't you go ahead and define that for me?
Tolerance is accepting things that typically would not be accepted. Right. Just saying it's okay. Right. You can do what you want. You want to run around with blue hair? No problem. I tolerate that. I accept you.
Well, that's what happens. See, when you accept the unacceptable, you get comfortable with the uncomfortable.
I know, and that blows me away. You had talked about estate planning, and life insurance can be used to cover estate taxes, final expenses, and equalize inheritances. Do you have specific estate attorneys that you will refer people to, or that you trust and use? Because I guess some people have had negative experiences with estate attorneys, so just trying to find good ones. Is that something that can be challenging?
Well, see, the only thing that would be challenging is the information that a person is using when they go to find this person. Okay. See, estate attorneys come a dime a dozen.
They do. No, I that's what they said.
Good ones are hard to find. This is why you have your specific questions laid out to go and see what kind of answers he's going to give you.
Right.
Okay? And when you hear the truth, you will know it. This is why asking the right questions is so critical in every area of life. All right? Because if you don't ask the right questions, you are not going to get the right answers. All right?
But I mean,
a lot of people want to tell you. Go ahead. I'm sorry.
No, I was just going to ask, do you purposely, I mean, do you specifically either refer or use specific estate planning attorneys that you trust with your clients?
Yes.
Okay. Because that's what I wondered, because I'm sure you develop a relationship with them, and there's ones that you trust more than others, and you feel better using them because you know they're going to do right by you and the client and do what's best for them.
Let me clarify a little statement.
I get my words right.
No, listen to me. I trust in the Lord and I love man. Okay, see, because God guides me to the business relationships that I have with other professionals. Okay.
Right.
And we all are on the same page when it comes to making sure that our clients are in the best position possible.
Right. Okay? Right.
So see, it's not a matter of trusting on my part. I love man and trust in the Lord. Okay.
That clears it up. That clears it up. So Sandy here, I guess, had a interesting claims experience, and she wanted to know, what should beneficiaries expect during the claims process? And she wanted to know if the agents have any capability to smooth that transition so the claims go through a little bit faster. I think she may have had a claim that it took a while to get paid off on, from what she's saying.
Well, that happens with a lot of companies, okay? Because that happens because the agent has a lot of influence on how the insurance company reacts. Okay, see, this is why we in a previous segment we talked about truthfulness and clarity in your application. Okay.
Yes.
We talked about that 2-year contestability period.
Correct. Yes.
Where I mean, you didn't disclose that you had diabetes or something like that. You know, that comes up and they can contest that. But see, the agent, it is his responsibility to make sure that the insurance company gets a great look at you as far as being able to cover you, to take the risk. Now, we know that you could die anytime. Okay? Yeah. We know that. And there is no deciding what day it's going to be, unless, of course, you want to commit suicide or something like that. But see, people die every day. And so as long as the insurance agent is crystal clear in the application about this individual, okay, that's going to smooth out the claims process and all that. It's what the agent tells the insurance company. Okay.
All right. So, Linda, Rob, I love your show. You make me laugh, and your host is out of his mind. You. This is Linda. But he seems to care, and you do too. And I never miss an episode. She wants to know, I guess it involves affordability and budgeting. What are realistic ways to fit life insurance into maybe a tight monthly budget without sacrificing coverage?
Well, see, number one is this is not something that you fit into your budget.
No,
okay?
Right.
This is something that should be in your budget.
It has to be there.
And you know what needs to fit into your budget? That cable TV. Them $4 or $5 lattes every day. Those are things that need to fit into your budget, but this should not have to fit into your budget.
Notice I'm not drinking Starbucks anymore.
I hear you, brother. I hear you.
Got me
I mean, you think about if you do this exercise, everyone listening, for the next 30 days, write down every dime you spend. Okay? And on what you spend it on. Okay? Because at the end of those 30 days, you're going to find out exactly where the holes are in your bag. Remember I tell people about that firm grip on the empty bag?
Oh, it's the bag. Empty bag.
Oh, yes. You can find out exactly what's going on if you record what you're spending every dime on for the next 30 days. And you will be pleasantly surprised that you can stop a lot of this frivolous spending and start putting that money to work for you as opposed to giving it to everybody else. All right.
So the last question, then we'll go to your presentation. Roland, I believe, is from Chicago, and he wants your opinion on this, I guess. Chicago-specific factors. Do you see cost of living, local taxes, and family structures? All the cost it has been going up. Is that able to influence coverage decisions? But like you said, coverage really isn't a decision. It's mandatory. It has to be there. So it has to fit into the budget. Something else has to be taken out. I think he's just saying, if you think Chicago has increased as far as the cost of living overall.
Well, see, he's broaching a couple of different situations in that.
Okay, I apologize.
Number one, things are not costing more.
Oh, it's the dollar being
devalued. Okay. Yeah. However, the ship is turning. Okay.
Oh, it is. Okay.
It takes time to turn a ship. You just don't turn on a dime. Okay.
No.
But yes, this thing is being totally reordered with the illustrious Donald Trump and the MAGA movement. They are changing everything.
But is Chicago typically, like, I know people in New York City have been fed up with the cost of living. Has Chicago increased the cost of living?
Yes, because of the simple fact that Chicago is a blue city. It is a Democratic bastion. Okay. That's why. That's the very reason why. Because the Democrats are in control. And I explain to people all the time, listen, whenever a politician stands up in front of you and tells you everything he's going to do for you,
they never do.
The first thing you need to do is ask where you're going to get the money from. Because everything that the government gives to the people, it must first take from the people. All right? No, and that's what, I mean, all this fraud and all this stuff going on, man, and people are you still claiming you're a Democrat? Really? I mean, it's both sides of the aisle. Our government is riddled with corruption.
No, it is.
Okay? And so what we need to do is we need to subpoena everybody. I'm talking, we're going to have perp walks all the way through. There should be no more career politicians. You do not have a person serve 40 years in office without corruption, brother.
No,
see, it's corrupt for him to be there for 40. Nobody voted this person in for 40 years.
Chuck Schumer, oh my God, no.
Not just him, but there's Maxine Waters and all the rest of these clowns. Man, I mean, it is ridiculous what we're at right now, and the only reason why we're here is because we have an ignorant population, which is by design. Because in this country, unlike anywhere else in the world, brother, in this country, we have a government of, by, and for the people. Okay, and I submit to you again that freedom is reserved for a knowledgeable and virtuous people. And that has been stripped away from us. Okay. Now, I mean, everything goes. Everything goes.
Yeah.
I'm telling you,
It is.
at the opening of the show, I mentioned the days of Noah. All right. You need to go back and look at why did or why was the flood released upon the world? Why? It is because
to get rid of the willfully ignorant.
not the willful ignorant,
The
evil.
evil.
Okay. It's the evil. Not ignorance is not a bad thing when you know you are.
Right.
But it is devastating when you have no clue. Okay. And what we have right now is they have been erasing the difference between good and bad. Like you ever heard somebody say, "Oh, you're a bad man."
Yes.
But it's meant as a compliment. But it's not so, brother.
No.
It's not so. Bad is bad. Good is good. Why not call him a good man? You're a good man.
Exactly.
You know, because bad is bad.
I totally agree. And we also had Linda ask, Rob, would you ever run for office? You seem like you'd be a perfect fit. And you would, but
actually,
I wish you would, but I know you won't.
Well, it has hit me a couple of times, you know.
I think, man, it's your calling, man. You have a passion.
As far as getting these people right, man. But see, the only way to get our government right is we have got to get our nation right.
Yeah.
Okay, we got to get our nation right, because the only way that they can get away with these things is because they're not being held accountable by the ultimate authority. That's the people.
They are.
That is the people. See, they have flipped the script where instead of the government working for us, we work for the government.
I know. And
that's
just
not the way it's supposed to be. That's not the way it is.
The budget not even being done. That still blows my mind that they can't get that right. I mean, we're going into May. Like, what are we doing?
And you know who's holding it up? You know who's holding it up? The criminals.
Yeah, the Democrats. I know.
Yeah, the criminals. And there are some rhinos in there too.
No, I know a couple have flipped, but it's because of ICE and this and that. It's just
no, it's not because of ICE.
I thought the Democrats wanted ICE regulated.
Listen to me. There's only one premise for this argument, and that is good versus evil. Period.
Okay, I agree.
That's it.
I agree.
Period.
I agree. All right. Which video would you want the video first?
No, yeah, the MP4 one, right?
Okay, yes. Got it.
Hello and welcome to the World News. Today we will talk about an author who is inspiring readers worldwide with his self-help and personal development books. His name is Robb Hill. Robb Hill is recognized as one of the nation's leading experts on safe investment alternatives. He is an independent financial advisor who has been helping consumers with tax advantage investment alternatives for over the past 15 years. According to Robb, ignorance is the biggest problem when it comes to financial preparation. Robb has written several books like Are You Willing? Start Over, and his latest book, Ask the Right Questions, Get the Right Answers, is a must-read for those who are planning for retirement and would like to retire with peace of mind and security. It does not matter if you are 35 or 65. This book will help anyone who wants to be financially savvy. The reason why Robb's books are so famous and loved by readers is because his writing style is simple, to the point, and relative to the situations many people find themselves facing. Also, he offers some amazing life-transforming lectures. His books are available on Amazon, and for more details about Robb Hill's books and lecture series, please visit rhillenterprisesinc.com.
So as we said, please visit rhillenterprisesinc.com for the information. Please go to Amazon and order any of Robb's books. He is an accomplished author. He will give you sound financial advice, and he gives it to you for a discount, in my opinion. So we will put this up here. And I do agree, Rob. If you ran for office, I would love it. I would be campaign manager.
All right.
I'd be your hype man.
I'll take that under advisement. All right. But yeah,
We'll raise money.
This is one of my structured presentations that I do for affinity groups and churches and the like, just to get people up to speed on options and why this is a solution for a wide range of situations that may come up. All right. So this is safe alternatives to the stock market. This is part 3 of our Back to Basics series. Okay. So outliving resources, what does that mean? All right. Inflation, a big old myth. Things are not costing more. Your dollar is getting weaker. All right. And I could go into that too, since the Federal Reserve started in 1913 and all that, but that's a whole nother presentation. Okay. Health and increasing life expectancy. Think about that. And the need for proper planning is what a lot of people are missing.
Right.
Okay. So sufficient retirement funds. Okay. Number 1, retirement is not an age. People need to realize that. When you bring up retirement to most people, I got 2 more years or 3 more years or 6 more months or whatever. Retirement is not an age. It is a financial position. Okay. If you got the money, you can retire now. See, you get 65 and you don't have no money, you have not been retired, my friend. You have been fired. You have outlived your usefulness. Okay. So you must learn to have money work for you. And this is where financial tools come into play. All right. And have you ever heard of compound interest?
Yes, you have educated me on that.
Compound interest is the 8th wonder of the world, and that was according to the illustrious Albert Einstein. All right. The rule of 72. People need to be familiar with this. Okay, and I'm going to explain that as we move along here. You've heard of the rule of 72, right?
Yes, sir.
All right. That's good. So what is the difference between qualified and non-qualified plans? And who decides which is what? This is our illustrious politicians at work again. All right. But qualified plans. The term qualified, when applied to annuities, refers to the tax status of the source of funds used for purchasing the annuity. These are premium dollars that have qualified for IRS exemption from income taxes, meaning that you put this money in this annuity before it's taxed. All right. The whole payment received each month from qualified money is taxable, since income taxes have not been paid on these funds, meaning simply this. You have got to the annuitization in the part of your annuity. And so you're going to be receiving a monthly outlay. Okay. That money is taxable because it was not taxed when you put it in. And now, since you're more mature, your tax status should have lowered. The group that you fall into should be lower.
Right.
Okay, so you're going to be paying the minimum amount of taxes on this money that you're receiving.
Right. Oh, okay.
Okay. So qualified plans are funded with pre-tax dollars and grow tax deferred. Tax deferred doesn't mean tax exempt. Okay. When you start taking this money out, it's going to be taxed. Okay. So for tax qualified annuity plans, the IRS generally requires that all policyholders begin receiving payments from their policies the year they reach age 70 and a half, or if later, the year they retire. Now, did you hear somewhere along the line that retirement age is 65?
I may have, Rob.
So you see, these things don't line up.
No, they sure don't.
This is what happens when you put. What I use the term is abdicate. A lot of people have abdicated the responsibility of retirement and left it in the hands of our illustrious government and their employer, which is a whole nother presentation altogether. But you have got to take 100% responsibility for your future, okay? Your financial future, to be exact, all right? It's not about what you make, it's what you keep that counts. And retirement is not an age. It is a financial position that you have prepared for all these years you've been working. But guess what? A lot of people ain't preparing for it because we live in this microwave society. We want everything now. Why do you think they make new cars every year? Why do you think they keep changing the fashion and all this kind of stuff? It's to separate you from your money.
That's what
it is. That's what it is. So, qualified plans may come from their corporate. These are sponsored retirement funds, the contribution plans. Can you say 401k and all? But let me keep going. Lump sum distributions from retirement funds such as IRAs, SEPs, 403bs. These are government employees. 457 plans, state and federal, and 401k plans. That's the private sector. All right. So this is where your qualified plans come from. See, you take your 401k is sitting at $750,000. Right. You got that sitting there right there, and you're leaving this employer. What do you do with that money? Okay. While it's $750K, you immediately reposition it. Because just like it's $750K right now, it could be $250K tomorrow.
Yeah. That's how volatile it is.
You remember the great reset of 2008 and all this kind of stuff?
Yeah, the bailouts. We all got bailouts. I didn't get mine, Rob.
The 401k turned into a 101k.
Yes. I'm still waiting for that bailout check.
Don't wait. Hey, look, don't hold your breath, brother.
I know.
Right.
I know.
So, non-qualified plans. These are contributions are made with after-tax dollars. See, this is why we got to get a rein in on our government, because they tax you and they tax you and they tax you. See, these contributions are made with after-tax dollars, means they taxed it. And then when you take your distribution, they're going to tax it again.
Are you serious?
Very serious. They double dip all the time, triple dip all the time. Mm-hmm.
I don't even know what to say to that.
No, there are no tax deductions for contributions to these plans, but interest grows tax deferred. Tax deferred means that they're going to get you later.
Yeah. They're going to get you later.
Yeah, they don't get you in the wash, it's going to get you in the rinse.
I know.
Yes. So, I mean, our government, they got their hands in every aspect of our lives.
I use so I gotta, when I quote you, I gotta cite you, because I quote you so much now. I gotta cite you. I gotta say, this is from Robb Hill, because I quote you so much.
Well, thank you. I do appreciate that.
I do.
Right? So listen to me. Non-qualified plans purchased by individuals may include savings accounts, certificates of deposits, money market accounts, and tax savings accounts.
My mother had a money market.
Right. These are not shielded from our government. You remember, you've heard me say many times, our government has an insatiable appetite for other people's money.
They do.
And this is where they got their hands all over everything. But see, you can position yourself in such a way that you can avoid all of that. Okay.
Now, it just, for instance, my mother, she has money market.
Mm-hmm.
If she were to transfer that and reposition the money, is there a tax for doing so?
No. What we would do is called a 1031 exchange.
Okay.
All right? As long as she doesn't touch the money, there is no penalty. That money will move from one institution to another institution. But she can't just take the money out and then take it to the end. Because as soon as she touches it, guess who else wants to touch it? Right.
The government.
So what we do is we do a 1031 exchange.
Okay.
And we move that money into a much better situation.
Correct.
As opposed to getting that 1, 2, 3%. You get 5, 6, 7, 8% over, you know.
This is going to be my ignorance, and I apologize. What is money market?
Money market is just another. No, it's another name for savings account.
Oh, that's all it is. Okay,
they just change the names around. They just change the names around. Give it a different name. Call it something like you take life insurance. You got mortgage protection. You got final expense.
Right.
Income protection. It's all life insurance.
It's all life insurance.
All life insurance.
All right, that clears it up.
All right. Then here we go. The annuity concept. Okay. Insurance companies cannot use your money to settle insurance claims, pay overhead, settle bad debts, and any other non-related annuity obligations. See, insurance companies are held to a much higher standard than banks.
Right.
Right. Yes, and I'm going to go into this. Mandated reserve requirements mean that when a fixed rate annuity is purchased, the insurance company, by law, must set aside dollar for dollar reserves to cover all anticipated payouts.
Correct. Yes, I know that.
They've got to do that. That means where's the money at? It's not at the banks, brother. It's at the insurance companies. Okay.
Right.
They got the cash. They got the cash. They have got to have it set aside in the event like a disaster happens, like the Hurricane Katrina and all this kind of stuff. You know,
correct.
All those people that had insurance had to get paid.
They did, yeah. But it took a while too.
But no, it's a lot of some companies they reneged on it too.
Are you?
Very serious, very serious. State Farm. I mean, they got lawsuits still pending today because
I know they do. I saw
things out.
Yep. I saw it on the documentary on Netflix.
Good Hands with Allstate said the hands was open. You know?
Rob, I saw the documentary about Katrina on Netflix. Yes. And you are 100% correct. Mm-hmm. There are people whose houses got destroyed and they did not get their insurance payout for it.
Well, look at the fires in California.
The wildfires too. Yeah.
No, the supposed wildfires. These ain't no wildfires, brother. This stuff is planned.
Yeah, I know. But I was shocked when the people were interviewed and they said that the insurance wouldn't pay out their claim for the hurricane. Just like, we're not going to pay.
Right.
Wow.
It's craziness. It's craziness. Absolute craziness. All right. So the insurer can only use these reserves to settle withdrawals and redemptions of annuity owners, meaning that they cannot do this with their insurance policy holders and all this kind of stuff. So the annuity section is separate. Okay. It is separate, man. You know, they got dollar for dollar. They got to have this in reserves. Okay. So the concept, the interest earned on traditional savings plan is taxed annually. Did you know that?
No, I didn't know that. They tax it annually?
Annually. When income is withdrawn from the annuity, only the gains are taxable and will be spread out over a number of years. Okay, meaning that your principal is safe. All right,
correct.
These are dollars that are working for you.
Correct.
And what it is known as interest.
Correct.
Okay, these are dollars going out and capturing more dollars.
Correct.
All right, and so when income is withdrawn from the annuity, only the gains are taxable. Meaning that if you have $100,000 in that's your principal balance.
Sure.
Okay. And then over the first quarter, it gained 10,000. You don't have to pay tax on 110,000.
You're only paying the 10.
On the 10,000. All right.
So is it is that why you're saying like annuities are a good option because you're paying less taxes?
Well, no, the reason why annuities are a good option is because let me clarify. The reason why I say that fixed annuities are a good option is because they totally avoid that volatility of the stock market. Okay.
Right.
It's like that you get the gains, but you don't get the losses.
So just so again,
it's like heads you win, tails you win.
Are we talking like these are IULs?
No, that is a whole different product.
Oh, okay. Sorry, my bad.
Whole different product.
Got you. Go ahead.
We're talking about fixed annuities.
Fixed. Okay.
And they also have equity index annuities too, which is another hybrid of a fixed annuity. Okay, but that's a different subject. But now, the retiree is usually in a lower income bracket. The taxes paid could be minimal. They should be minimal.
Right.
Okay, this is where that solid financial plan comes into play. Comes into play, and we look at everything that we possibly can look at to ensure that you're keeping more of what you have earned and not giving it to our illustrious crooked government. Okay. All right. And we need to abolish the income reduction squad.
The income reduction squad.
Mm-hmm. So the historical background of annuities. Okay. This didn't just come about. Okay.
Really?
These were used extensively in England in the 17th century. Okay. Why? They used as a safe income-producing retirement plan for investors at that time, and they are still being used today. Okay. They're still used today as a major tool in retirement planning. See, listen to this verbiage here. A major tool in retirement planning.
Well, like you said, a hammer's a good tool.
Oh yes, but if you want to drive a screw, you have to get another tool.
Exactly.
And that does not mean throw away your hammer. Okay.
Yeah.
You might need to use it for something else. Okay.
Yeah, exactly.
But so we load up your toolbox, and this is from Ben Bernanke. He was the chairman of the Federal Reserve. We're talking a few terms ago here. Okay. Sure. So, what is a tax-deferred annuity? A fixed annuity is a contractual arrangement between an insured and the insurance company wherein a premium or premiums are paid in exchange for an interest-paying plan that will provide a stream of income payments when called upon by the owner. This is where you take your dollars and you treat them as soldiers.
They go to work for you.
Yeah, you go out there and get some prisoners. All right. You go out there and get some prisoners, all right? And this is a beautiful thing, man, because, oh, my God, it gets really good. And there are different strategies to use
with
these annuities, too, man. And I could go into so many different
avenues. I mean, I'm just thinking to myself, if someone comes to you and they say, I have $100,000 to invest in life insurance, you can put them in several different things. Like you could do annuities, you could do permanent, right? Like you're not just doing one thing necessarily.
Actually, if a person came to me and said, I have $100,000 I want to invest in life insurance, I would say, you got the wrong one, brother. You're not investing.
I'm sorry.
No, you're not sorry. I mean, you're just coming from where you're at. But this is positioning.
Positioning, correct.
Right. This is not investing. Investing, the bottom door of investing means that there could be a loss.
Correct. So the phrase investing would be the wrong.
We're not investing here. We are repositioning.
Yes.
Okay.
So I'm just saying, if someone says I have $100,000 to reposition and I want to do some life insurance, you can put them in annuities a trust, and an insurance policy, right? You can use several of those tools, right?
Right. Well, we would do that needs analysis.
Needs analysis, correct. Sorry.
And then we have to do what actually they want to occur.
Okay.
Okay, so we look at the needs analysis, and then what do you want to occur?
But you also, I mean, and you can suggest what may be in their best interest for what they want, but ultimately, it's their decision. But I'm sure that you try to point them in the right direction and say,
we don't try. There's only do or do not, brother.
Well, I get that. I'm sure listen, you're black and white. I'm sure you tell them, hey, this is the way to go.
Right.
Either you want to do it or you don't.
Right.
And you, after the needs analysis, you put together the plan, and then it's up to them whether they do it or not. Right.
Right. Well, see, what usually happens is we sit down and we go over everything and what their goals are, and put together a plan. And 99.9% of the time, it's a go, brother.
Right. Okay.
Because their best interest is at heart.
But I'm saying that, like, all these different tools can be part of the plan.
Well, as many of the tools as possible are going to be part of the plan, because we want to make sure there are no holes in
They're
this
protected.
process. All right.
Like,
That's what we're going to do. Everything that can be used will be utilized.
Got you. Okay. That makes sense.
It's all about protection.
Right.
Okay. It's all about protection. So, tax-deferred growth is one of the chief reasons why tens of millions of people around the world are attracted to fixed annuities. You hear that? Tax-deferred growth. Not only that, but also the guarantee of principal. That is another major factor.
Because it's not ever going to go below that. Right.
Okay. The rule of 72. Take notes, everyone. The rule of 72 is a simplified way to determine how long an investment will take to double. Given a fixed annual rate of interest, let me start over. The rule of 72 is a simplified way of determining how long an investment will take to double, given a fixed annual rate of interest. By dividing 72 by the annual rate of return, investors can get a rough estimate of how many years it will take for the initial investment to duplicate itself.
Correct.
I.e. double. Okay.
Yeah.
For example, the rule of 72 states that $1 invested at 10% would take 7.2 years to turn into $2. And this works with all numbers, any numbers you want. Okay.
Correct.
When dealing with low rates of return, the rule of 72 is fairly accurate. I mean, it's right. It's real close. All right.
Yes, I have heard that. Yeah.
You can change these things when that interest rate number changes. See, this is the simplified way. We're using 1.
Correct. Yeah. Right.
And 10%. These are round numbers. All right.
Yeah. Just so people can understand.
You're getting 12.5%. It makes a huge difference, because not only are you getting interest on your annuity that's in there, but it's the interest is compounded.
It keeps earning.
Compounded is interest on top of interest.
Yes.
Okay. See, where do you think they come with that APR? You know what that is? The annual percentage rate?
No, sir.
Well, that's what they use to beat you upside the head with.
I think I've been beaten enough.
And while they beat you upside the head, they got their hand in your pocket.
Yeah, I knew you were going to say that too.
Okay. But I digress. Let's continue on. Okay. There are 2 types of annuities: variable and fixed.
Okay.
The variable annuity, which is something I do not recommend for my clients, because most of my clients don't have time to play catch up. We want safety now. Okay.
Correct. Okay.
So a variable annuity. Premiums paid into a variable annuity are placed into one or more accounts. These separate accounts are made up of equity accounts, usually a mutual fund and some other types of funds too. They carry the same risks as regular equity investments. There's no guarantee on principal. This is why we don't even go here. No guarantee. Okay. Variable annuities are tied to market values, which may fluctuate daily. There's not which may, they do fluctuate daily. Okay. There are many costs associated with variable annuities not found in fixed annuities. Okay. So this is where, you know what, no matter what happens to your variable annuity, the people that put you in is still gonna get paid.
Wow.
Just like those 401k hedge fund managers. All right. No matter what your 401k does, they still gonna get paid. Okay. Yeah. All right. So these costs include management costs, advertising costs, premium taxes, sales expenses. With variable annuities, it is possible that principal may be lost, just as any market-based investment. Okay. You know, they tell you with big rewards come big risk.
Well, that's what I'm saying. Like, why would you get into this? Just because the reward has the potential of being bigger, even though you could lose significantly more? I know I'm not understanding it all, but that's kind of just what I'm saying.
These products here are sold based on projections.
That's my point. Yes, you're estimating
based on projections. Okay?
Yes,
and so I mean, there are people that still do these things, but when it comes to my clients, safety is the
you're not gonna risk that. Right. I understand.
Okay, so fixed annuities. Fixed annuities protect against the volatility of the stock market. Fixed annuities are the only investments that can guarantee an income for life.
Correct.
No other investment provides tax advantages and absolute guarantees like the fixed annuity.
Correct.
Investment. Okay.
Because it's never going to go below what you put in.
No, your principal is intact.
Safe. Yes.
And you're just going to be getting that interest every month.
The compounded interest, yes.
Okay. Fixed annuities have no investment risk by the owner, as in the case of variable annuities. Fixed annuities are free of market risk. Fixed annuities are a safe method for the investor to enjoy a higher rate of return that is sustainable.
Yes.
Okay. It's a beautiful thing. It's a beautiful thing. We like clarity.
How many years typically will people be in annuities? Is it something?
Well, it varies. It's 3, 5, 10. I mean, it could times. We just. I mean, there are lots of different times, different prices. No set time. Okay.
Okay.
Fixed annuities provide an income that cannot be outlived and can be structured to provide long-term care benefits. See, this is where a lot of people don't understand about. Wow. Remember when I went into the Medicare, that's another presentation.
Yeah.
But long-term care, that's another presentation where I go into the cost of nursing homes and all this. We're talking.
That blew me away.
Yeah, $5,000 to $6,000 a month. Okay. And so what you do is you have your dollars out there working for you, generating that income just in case it's needed.
Yeah.
If it's not needed, guess what? You still got the money.
Correct.
Okay.
Correct.
And this is where you have your dollars working for you as opposed to you working for the dollars.
That's what you're supposed to be doing.
People need to start doing this at a young age.
Absolutely.
Right? Start having these dollars working for you, man. I mean, you look at everything now. Everything has a cost or fee associated with it. Everything does. You know, I just got my new phone. All right, man. I'm getting spam blasted with all kinds of stuff, man.
They already know your number, man. They're already blasting you. Yep.
Yeah, and they nickel and dime you straight to the poorhouse, brother.
Dude, they do. They do.
Oh yeah.
It's unbelievable the scams that go on and the calls that come in. They know who you are, so they'll use your area code to make sure that you answer. It's
it's wild. And you know what's doing a lot of that? Artificial intelligence. Artificial intelligence. I heard a comedian one time, he was talking about, there's something really wrong, right? When you go and get something that's supposedly like lemon meringue pie or something like that, and it's got all these artificial sweeteners and artificial flavors and all that stuff added to it, but then when you go over to the home section and get you some liquid pledge, and it's got real lemon in it.
It does.
Now, I thought that was, then he pointed that out. I was like, wow, that is so true. We're eating all the fake stuff and the real stuff getting sprayed on the table.
Yeah, no, I know. It's crazy.
Okay, so again, I'm going to say this again. Fixed annuities provide an income that cannot be outlived and can be structured to provide long-term care benefits. And we talk about long-term care in another of my presentations, but the advantages of the annuity. A fixed annuity protects and builds cash reserve. Listen to that, ladies and gentlemen. Listen to that. A fixed annuity protects and builds cash reserve. That's a beautiful thing. There are no commission charges when a fixed annuity is purchased. All right.
So I'm just asking, what's the advantage for the agent to sell a fixed annuity?
The advantage for the agent to sell a fixed annuity is the comfort in knowing that he has helped position this person in a better place.
I got you. Okay.
Right.
I
understand. Your rewards are going to come. Your rewards are in direct proportion to the problems that you help solve for other people.
That I agree.
Your rewards in life are directly tied to the problems that you solve for people, or the problems that you create. Mm-hmm. Okay.
That I understand.
All right. The advantages, the guarantees of safety, interest rates, and lifelong income give the purchaser peace of mind. And this is all explained because when you buy this annuity, or when you get into this specific plans, what we do is we go line by line over everything to make sure that it is crystal clear. Okay, there will be no surprises down the road. Okay, and like I said, many times I sit down with people and say, "Well, the insurance man said this, or my insurance carrier said this." I said, "Look, it does not matter what your insurance man said. What matters is what's written in this contract."
Exactly.
Okay. You got to read the fine print. You got to be familiar with exactly what's supposed to be happening, because it's not going to do you any good to call your insurance company up all upset and screaming, "Well, the agent said this, the agent said that." Well, that don't matter. You care what the agent told you. It's all about what's in that contract. Okay. And this is where an agent or representative that is on his game will make sure that you have a total understanding of what's going on. Features and benefits. Earnings accumulate tax deferred until the owner receives payments. This is crucial during the accumulation phase. The accumulation phase is when the money is sitting there and it's just receiving the interest payments getting stacked on top of it. And that interest is compounding. It's a beautiful thing. All right?
Yeah.
You just keep on doing what you're doing, and you letting them dollars work for you. Even while you're sleeping, they're still working.
That's amazing.
Yes, it's a beautiful thing. It's a beautiful thing. Features and benefits. Your funds are positioned in a professionally managed portfolio with some of the strongest insurance companies in the world. You got your Globe Life, your Allianz. There's a lot of them. Okay, I only represent A-rated companies. Okay.
Right.
So the features and benefits. See, listen to this. Annuitant can terminate the fixed annuity at any time he or she wants. So you're not locked in. Okay. Taxes must be paid at the time on the earnings. There could also be a substantial surrender charges. Remember in a previous episode, we talked about surrender charges.
Yes, we did.
Surrender charges are what happens if you back out of the contract. Say you got this thing for 7 years, and in year number 3.5, you want to pull out. Well, there's surrender charges for every year up to the 7 years, and it drops every year until it gets down to zero in the final phase of the annuity. Okay, so that's what the surrender charges are. The last question that we had from a client in the previous episode, she was saying, well, she had surrender charges and premium things and all this stuff mixed up in there. She was talking about different products, but she didn't know it.
Exactly.
She didn't know it. She had everything commingled together. And so, but it's good. She did have a grasp on some things, but when you mix them all together, you don't get the right answer. Okay.
No, exactly. It's all about the question.
Yes, it is. So risk versus reward. Listen to me. And this is Robb Hill. It's not how much you make. It's how much you keep that counts.
Okay. Absolutely.
Right? Long-term or short-term, long-term or short-term, and make up for losses. See, making up for losses is not guaranteed, brother.
Right.
You know? You look at those people that worked at Enron and WorldCom and all that kind of stuff when the scandal broke, all right? Now, how you going to make up for all that? Right? Because what you thought, I mean, it's the ghost, the smoke and mirrors, brother. I mean, like they say, like, you know, and I digress right here, you know, they say you got the 401k plan and we're going to match you. Well, that's a good thing you want to match me, but I don't want to put my money over there. I want to put my money over here. They say, well, no, you can't do that. Well, why can't I do that? Because we're in cahoots with all the rest of this stuff. It's all one big thing, right? They think, I mean, you think you got choices, but they're all their choices. You know, it's really wild, man. People just don't.
I just, the more I learn, the more I'm in shock.
Okay, let's listen to this. The solution. Look, don't put all your eggs in one basket.
And I agree.
That depends on the basket too, because you can't carry 3 baskets. All right.
And you can't carry a basket that has a hole in it.
Right. Yeah, that's right. And a lot of people got a hole in their bag.
They do.
They got a firm grip on an empty bag. So diversification of assets. This is safety. I mean,
now I understand.
We're going to do this, and I mean, there's a whole lot that goes into that diversification thing. Okay.
Now I get it, though. I mean.
Mm-hmm. And ratings from A to AAA. I only represent A-rated carriers. Okay.
Correct.
So the ratings are based on the analysis of financial results and evaluation of management objectives and strategies of each individual company.
Okay.
So how can I make sure my money will be available when I need it? How can I get some of my money out without paying penalties or interest? See, all these things refer to liquidity. Okay. The problem, liquidity. Most financial accounts charge penalties for withdrawals before maturity on the entire account value. The ability to withdraw money when needed without paying excessive penalties or losing up to 6 months interest. See, those are problems. Now,
very much so.
Solution. Fixed annuities have many guaranteed flexible withdrawal options. You can take money out without paying any penalties or charges. Okay? These are called RMDs. Those are the required minimum distributions, which was brought up by our illustrious government, who need, I mean, you know, we have got to rein this government in, brother.
I see that more and more.
We have to. We have to. And Trump is just doing. Oh, he's just wreaking havoc on them, man. I just love it.
He
I
is.
just love it.
He sure shit is. I give him credit for that.
Yeah. So listen to this: federal income taxes. This is interest earned on checking accounts, CDs, stock mutual funds, except special tax refunds, bond mutual funds, T-bills, dividends on common stock. They got their hand in every aspect. So all are all taxable by the federal government each year when interest is credited, even if it isn't taken out. See, they got their hand in the cookie jar all the time, double dipping, triple dipping even. You know, they tax you when you make it, they tax you when you save it, they tax you when you spend it. I mean, everything is going. I was at the store one time, man, and the ladies rang up my stuff and gave me the receipt. And I started looking in the bag, and she said, "What are you looking for?" I said, "I'm looking for taxes."
Right.
I ain't no taxes in this bag. Where are the taxes at? Why am I paying taxes? But I digress. That's another situation. But the solution: the interest income credited to your annuity is not currently taxable by the federal government each year. You hear that? You hear that? Okay.
Absolutely.
You will not pay taxes on your fixed annuity interest income until you take it out of your annuity, but usually at lower income tax rates. This is because your tax bracket has changed because you now stop working. Okay, so now you want to live off of all that money that you've been saving up over all them past 40 years of your working life.
Absolutely, which is ridiculous.
That's the way it used to be, though. But now,
I know.
I mean, but that's a whole nother presentation. All right. So the problem: state income tax, interest income earned on checking accounts, saving accounts, CDs, bond mutual funds, dividends on common stocks, and stock mutual funds are taxable in most states each year when interest is credited, even if we don't take it out. This is why they want to look at all your financials when you're talking to the income reduction squad.
Right.
They want to make sure that they want to make sure they're getting out of you every dime they possibly can. Okay? And why? So they can fund these fraudsters out there. You know? You really most people have no idea how much money runs through our government's hands.
It's insane.
It is. I mean, it is astronomical. Astronomical. So, the solution: interest credited to your annuity is not currently taxable in any state. You will not pay taxes on your fixed annuity interest income until you take it out, and that's going to usually be at a lower income tax rate. Why? Because you're no longer working. Okay? So it drops substantially. So how do I how do I make sure my heirs will be protected in case of my premature death? Ha! That's a beautiful thing. And it's not just this right here, because this is tied into some other tools that are in your toolbox. Okay? Probate costs. Remember, we broached that. That's where some bureaucrat sits back and decides what exactly and how, who's going to get your stuff. All right? So probate administrative costs and fees usually average 8 to 10% of the assets. So just imagine if you had $1 million in assets and it went to probate. Guess what? $100,000 of that is going to the illustrious government.
$100K?
Because they didn't take the time to make a will and a trust.
$100K?
Huh? Yeah. Listen to this. Listen. Average 8 to 10% of the assets. Mm-hmm. And when they talk about your assets, they add up everything: the real estate, the business, your cars, all this kind of stuff. And it's all getting one lump sum, and they're there to get their piece. We want our cut of the pie. All right. So Assets are not available to the heirs until the estate is approved by probate court. You avoid that totally by getting you a will and a trust set up. Listen to this. Average time assets remain tied up in probate court is 1 to 2 years. You hear me? We want to avoid all of that, and we can do all of that. Okay? And here we go. Probate costs continued. All records of the assets are available to the general public. You brought this up several times in the presentations.
Okay? Yes.
Yes. The court, in absence of a will, transfers the assets to those family members as directed by law. All right. You remember we went into a bunch of different things with the wills and trusts. All right. Because all of these things are inextricably intertwined. Okay. You just don't do the one thing. Well, I'm gonna get the life insurance and not have a will. Or I'm gonna get the will and not have life insurance. No, you need to get all this stuff together to get your ducks in a row. You understand what I'm saying? You with me?
I'm with you. I'm shocked.
Don't be.
It's all available to the general public.
Oh yes. You brought that up several times about the challenge. Can the will be challenged and all? Yes, most definitely. I remember I said to you several times, you got the cart before the horse.
Yeah, you did.
Okay. All right. So a fixed annuity with a properly designated beneficiary other than your estate, i.e. trust, will bypass probate and eliminate all probate administrative costs, fees, and delays and publicity. All right? All. And what don't you understand about all? Okay? At death, more of your money will go to those family members you choose, and you do this from your grave. You can have everything going exactly where you need it to be, and preferably that's going to be in the trust. Okay, not the cash, but the assets are going to be held by the trust, and that's a whole nother conversation, though. Okay. So, the problem: guaranteed retirement income. 2 guarantees for your retirement income. These are only things that annuities can produce. Okay. Your monthly income check stays the same every month, never decreasing when interest rates decline. Your monthly income checks must keep coming to you for your entire life, no matter how long you live.
Right.
Okay.
Wow.
Yes. The solution, the fixed annuities guarantee. Monthly income checks can be the same every month. Your income will never decrease when interest rates go down. Your monthly income checks will be there as long as you like. With a life income option, your money will never run out.
Exactly.
That's a
which I like.
Thing. Yes. So safety of principal. Most investments do not guarantee that the principal will never be less than the original investment. That's most of them. Unlike other financial products, fixed annuities guarantee that your principal will never be exposed to market risk. Your policy values will never go down because of market fluctuations. Your policy will only go up as your guaranteed interest is credited each month until you take your income payout. That is a beautiful thing.
It is.
Right? How can I guarantee my monthly income and my principal? Simple. Call Rob. No. The problem, your interest income after paying income taxes is not enough to meet the increasing cost of living. You need to increase your monthly interest income without adding any investment risk. And how do you do that? With a fixed annuity, it is possible to increase your after-tax income for either more income, monthly income right now, or more monthly income starting at some later date. You pick, and lasting for your lifetime and beyond. It's a beautiful thing. That's called money working for you, brother. Excuse me. There is no market risk with a fixed annuity. Your money is safe. You can count on the return of 100% of your principal. plus an additional return on your money. Okay, this is a beautiful thing. This is the safe investments to the stock market, brother. Investment effects on Social Security benefits. That's not Social Security. I mean, this is a great topic to talk about, right?
Yes.
Interest income earned and credited on most investments like mutual funds, savings accounts, CDs, and bonds are reportable as income, which may decrease your income tax on Social Security benefits, or it may increase your income tax on your Social Security benefits. See, once you start receiving Social Security, there should be no tax, right? There should be no tax on that. And that's what our illustrious Trump is doing. He's taking them taxes out of there, man. You know, how you keep paying taxes on a house that's already paid for? Right? These are all schemes to rip you off. And they are done by our illustrious government, and we sit back and let them do it because we have not held them accountable. And we got a bunch of shysters and charlatans in our government, man, riddled with corruption. The solution: interest income earned and credited on fixed annuities is not subject to either federal or state income taxes until the money is withdrawn. See, unlike CDs and savings accounts and all this kind of stuff, they tax you every year, whether you take it out or not. You're still getting taxed on it.
Every year?
Every year. Every year. Yep. Such interest income is tax sheltered and authorized by the Internal Revenue Code. All right. This is when you park your money, not over here, but you park it inside this financial product, this tool. And then you get all these benefits to go along with that. When you take money out of your fixed annuity, depending upon the income option you choose, up to 85% of your monthly income may not be subject to any income taxes. Okay? That means that 15% is what the income reduction squad has got their hand out for. All right? Less taxes will be paid and more of your Social Security income benefits will come through to you. We got the illustrious Trump doing his thing, man, and he's going to eliminate all them taxes on the seniors that are in retirement. Just eliminate all their taxes. They've already spent the rest of their whole entire lives paying taxes. Well, I shouldn't say paying taxes. Let's say they've been getting taxes taken. All right? Because, I mean, you ever heard of FICA, right?
Yeah. Oh, yes.
Yeah. Medicare, Medicaid. Who are these people? That's why W-2 wage earners can never pay themselves first, because somebody's already been there.
Right.
Yeah. Yes. It's a beautiful thing. So the problem: charges and fees. Most financial investments and financial accounts charge administrative, sales, investment fees as a percentage of total assets. So it's a sliding scale. If you got a lot of assets, you pay a lot of taxes, or a lot of fees. If you don't have a lot of assets and all that kind of stuff, you pay less in fees and all that. So it's a sliding scale. So it's a percentage. Subject to distribution requirements, most fixed annuities have, listen to this, no sales charge, no monthly administrative fees, no state premium taxes to pass on, and no investment fees. All right? These soldiers are free to do their work, brother.
Right.
Yes, it's a beautiful thing. Vital steps you should take before you retire, not before you hit 65. You hear me? This is right. Before you retire.
Get it done.
Retirement is not an age. It is a financial position. So, first, obtain a full financial statement. Second, obtain a comparison of financial assets that will help you decide where your assets will have maximum protection while giving you maximum income. All right. So those are the two things that we need to do right there. And that concludes this presentation. All right. Any questions that anybody may have, they're going to send them to
Yeah.
you. Whatever, we'll broach those in the next
You know
episode.
what? We'll definitely try to do a show Friday because there are quite a few questions.
Yeah.
So we'll go over them then. I apologize. I brought up IULs, and this is completely different. So do you mind explaining the IUL thing to me again? Because it's not.
Well, IUL stands for Index Universal Life.
Index.
Okay.
It's
index meaning that it flows with the gains and losses of the stock market. Okay. And so that's all it is. It's tied with the gains of the stock market. And IULs are usually sold based on projections.
Right.
Okay. This is what may happen.
Correct.
And that's what they're sold on. Okay. But yeah, I mean that's it. It's a viable product when you know how to use it. Just like I say many times, a hammer is a beautiful tool. Right. Yeah, but you need another tool when you want to do something else. Okay. But an IUL is a viable strategy for different situations.
All right. Well, Rob, I got to say, thank you for answering questions. This was a eye-opening presentation, sincerely. And we will talk more on Friday because I'm sure we have some questions to go over, but we appreciate it. I'll talk with you and keep in touch about tonight to see if we can get you on at all if you're available. If not, then next week. But everyone is grateful.
Yeah, next Monday you can pencil me in. Next Monday we'll be there. Next Monday for the entirety of the show. Okay.
I will make sure to let you know
tonight,
for sure.
Right now, I think my window has closed to be able to rearrange.
That's no problem. Right. We're usually on from 8:30 to 9:30, 9:45. So if you do even have like 10 minutes, I'll bring you on. You just text me, call me, and I'll send you the link.
All right. Well, I'm pretty sure I'll be tied up.
I got you. The guys
next Monday I will be there for the entirety.
The guys want you to come on big time. So, but Robb Hill, R Hill Enterprises Inc. Please go to his website. You can email him at Robb at R-Hill.
ROBB.
That's right. That's two B's. That's two B's. Yes. Two B's. And also, Robb, thank you for your recommendation for me on Alignable. Truly appreciate that. I gave you one as well. And I think it's going to work out. I got a connection for you. I'm going to try to get going. But just remember, this has been In Focus. When life gives you lemons, don't make lemonade. Take 2 oranges, throw them right back in life.